In Austin and Dallas, the housing boom has reversed almost overnight. What was a frenzy of bidding wars in 2022 is now a record flood of homes for sale in 2025. With prices falling, inventory doubling, and over 80% of Austin sales closing below asking. The story behind the Austin and Dallas, Texas housing market crisis runs deeper than headlines admit. If Texas was supposed to be real estate's safe haven, how did it become the bellwether of the country's next correction? Here's what the numbers reveal, and what homeowners and buyers aren't being told. March 2025 set a new record for homes for sale in Austin. Active listings soared past 16,500 by mid-year, the highest monthly count ever recorded in the city's MLS history. For comparison, just 3 years earlier, Austin's entire market hovered near 2,000 homes for sale at the peak of the pandemic boom, a more than 7-fold increase in available inventory. By October, the number remained elevated, with over 16,400 homes still on the market, and year-over-year growth outpacing every other major Texas metro. In Dallas-Fort Worth, the pattern was just as pronounced. Inventory climbed more than 31% compared to the previous year, pushing the region back to pre-pandemic levels and, in some submarkets, to 20-year highs. This flood of listings is not just a headline, it's a daily reality for agents and buyers. In Austin, neighborhoods like Pflugerville, Leander, and Georgetown saw thousands of new homes hit the market as builders delivered on projects started during the frenzy of 2022 and 2023. Meanwhile, resale inventory swelled as existing owners, pressured by job changes, relocations, or financial strain, listed homes that might have otherwise stayed off the market. The result is a landscape where, on any given weekend, buyers can choose from dozens of options in the same price range, often within the same subdivision. The composition of this inventory tells an important story. New construction, especially in the $350,000 to $550,000 range, accounts for a large share of the surge. Builders who once struggled to keep up with demand now find themselves offering aggressive incentives, rate buydowns, closing credits, and upgrades to move unsold homes. At the same time, investor-owned properties and short-term rentals are being liquidated, adding to the supply and intensifying competition. This unprecedented inventory buildup is more than a statistical blip. It signals a fundamental change in the market's balance of power. With supply far outpacing demand, the days of rushed decisions and bidding wars have faded. The sheer volume of active listings is the first and clearest warning sign that the market's center of gravity has shifted, setting the stage for the price and negotiation dynamics that now define the Austin and Dallas housing crisis. In the 2 years between 2020 and 2022, Austin and Dallas became the epicenters of a housing boom that seemed unstoppable. Home values in Austin soared to a median of nearly $570,000 by the summer of 2022, a figure that dwarfed pre-pandemic levels by more than a third. Dallas followed a similar path, with median prices climbing close to $450,000. For many buyers, especially those who entered the market at the height of this surge, these numbers set expectations that now feel like a distant memory. The rapid appreciation was fueled by a unique mix of factors: a flood of remote workers, tech sector expansions, and a national migration wave that funneled buyers into Texas metros. Bidding wars became routine. Offers routinely landed $50,000 or more above asking price. In Austin, homes sometimes sold within days, with sellers fielding dozens of offers. The market's momentum created a sense that prices could only go up, and buyers who waited risked being priced out forever. But the reality of 2025 looks very different. Median prices in Austin now hover around $520,000, and in some neighborhoods, dips of 10 to 15% from the peak are common. Dallas, too, has seen values settle back, with citywide averages off by as much as 8% from their high water mark. The gap between what buyers paid at the top and what homes now fetch on the open market is impossible to ignore. For those who purchased in 2021 or 2022, the math is stark. Equity built on paper has evaporated, leaving some homeowners owing more than their property is worth. This new reality weighs heavily on both sellers and buyers. Sellers who anchored their expectations to 2022's record prices now face hard choices. Either cut their asking price or watch their listing languish. Buyers, meanwhile, approach negotiations with caution, aware that values can fall as quickly as they once rose. The era of the so-called peak buyer, those who stretched financially to secure a home at the top, has become a cautionary tale. Many are now locked into high payments with little or no equity cushion, and the prospect of selling without taking a loss feels all too real. The psychological impact of the boom and bust cycle is evident in every conversation with agents and homeowners. Optimism has given way to anxiety, and the once unshakable belief in Texas real estate has been replaced by a more sober, calculated approach. The legacy of the 2020 to 22 surge is not just in the numbers, but in the sense of vulnerability it has left behind, setting the stage for the negotiation-driven market that defines Austin and Dallas today. In Austin, the rules of engagement at the negotiating table have been rewritten. By August 2025, the average home sold for just 96.25% of its list price, meaning buyers are routinely paying nearly 4% below what sellers originally asked. This is not a statistical quirk, but a new baseline. Earlier in the year, about 80.2% of all Austin home sales closed below the original asking price. For agents working the front lines, this shift is unmistakable. We used to see offers come in over asking, sometimes with no contingencies, says one veteran Austin broker. Now most buyers expect to negotiate. They want concessions, repairs, closing cost credits, even rate buydowns. And they're getting them. Transaction records from the spring and summer show a pattern. Initial listings sit for several weeks, prompting price reductions. When offers do arrive, they're often 2 to 4% below the new, lower list price. Inspection periods have become battlegrounds for further negotiation, with buyers demanding credits for even minor issues. In many cases, sellers agree, aware that the alternative is watching their property languish for months. The days of buyers waiving inspections or skipping appraisals are long gone. Instead, buyers come prepared, armed with data and time on their side. This new leverage is not limited to a handful of deals. It is now the standard in Austin's market, reflected in contract after contract. Sellers who resist this reality often find themselves forced to chase the market downward, making multiple price cuts before finally reaching a deal. For buyers, the shift means more choice and more power to shape the terms of a sale. For sellers, it means recalibrating expectations and accepting that the market sets the pace. The average sale-to-list price ratio, once a measure of market heat, now serves as a barometer for buyer strength. What's happening in Austin is more than a return to pre-pandemic norms. The sheer volume of below-list transactions and the prevalence of concessions reveal a market where buyers, not sellers, are in the driver's seat. This structural change is visible in every signed contract, every price reduction, and every closing statement. It's a dynamic that is reshaping not just how homes are sold, but how value is perceived across the city. In Dallas-Fort Worth, the housing market is facing a parallel reckoning. Inventory has surged by more than 53% in 2025, pushing the region's supply to levels not seen in nearly 2 decades. This dramatic increase isn't limited to a handful of neighborhoods or new developments. It's visible across the Metroplex, from the urban core to sprawling suburbs like Frisco, McKinney, and Mansfield. The number of homes for sale now routinely exceeds 16,000, a figure that would have seemed unthinkable just a few years ago. The consequences of this oversupply are unmistakable at the closing table. Data from the regional MLS shows that 66% of Dallas area homes are now selling below their list price. In practical terms, this means that for every 3 homes sold, 2 close at a discount, often after weeks of price reductions and stalled negotiations. The average sale-to-list ratio in Dallas has dropped to around 94 to 95%, with many higher-end listings facing even deeper cuts before finding a buyer. For agents and sellers, the shift has been jarring. Properties that once attracted multiple offers now linger for 60 days or more, and price cuts are no longer a sign of distress. They're a routine part of the selling process. Builders, especially in the northern suburbs, have responded by halting new projects and offering aggressive concessions to clear out unsold inventory. Some have gone so far as to lay off construction crews, unable to justify further investment in a market flooded with options and thinning demand. The impact is felt across all price tiers, but it's most pronounced in segments that saw the fastest growth during the boom. Entry-level homes and mid-tier new builds, which once moved quickly, now compete with a rising tide of resale listings and investor-owned properties. In some submarkets, buyers can choose from dozens of nearly identical homes, each offering a new round of incentives or discounts. The result is a competitive environment where patience and negotiation have become the norm, and where sellers must confront a new reality. The days of automatic appreciation and instant sales are over. This pattern in Dallas-Fort Worth underscores that the forces reshaping Austin's market are not unique. The same inventory glut, buyer leverage, and downward price pressure are playing out across Texas's largest metros, signaling a broader recalibration that extends beyond any single city or neighborhood. Not every neighborhood or price range in Austin and Dallas is feeling the downturn in the same way. Beneath the citywide averages, the impact of the housing slowdown splits sharply by both price tier and geography. In Austin, the median listing price in mid-2025 stands about 1 to 3% lower than last year, a modest dip compared to the steep declines seen in select pockets. Some outlying suburbs and older neighborhoods, especially those with long commutes or lagging infrastructure, have seen prices tumble 10 to 15% from their pandemic peaks. These areas, flush with speculative new builds and investor-owned properties, are now grappling with a glut of unsold homes. Sellers in these zones often face repeated price reductions just to attract a single offer. Entry-level and mid-tier homes, once the hottest commodities in the market, now linger on the market for weeks or even months. The pressure is most acute in subdivisions where new construction has outpaced buyer demand. In places like Manor, Hutto, and parts of North Austin, buyers can choose from a dozen similar listings, each one offering a new round of incentives or discounts. Sellers who bought at the height of the boom are especially exposed, sometimes forced to accept offers below what they owe on their mortgage. For these homeowners, the correction isn't just a headline. It's a daily calculation of risk and loss. Luxury and new-build homes in premium locations have so far proven more resilient. In central Austin, Westlake, and parts of Dallas like Highland Park and Lakewood, prices have softened but not collapsed. Well-located properties with strong school districts or walkable amenities continue to attract steady interest, though even here, days on market have crept up, and negotiation is the norm. Some sellers in the upper tier still manage to close near their asking price, but the days of multiple offers and bidding wars are gone. The divide grows sharper as you move farther from the urban core. In the outer suburbs, where infrastructure lags and job access is weaker, the combination of high property taxes, rising insurance costs, and slower buyer traffic has made price cuts routine. Builders in these areas, facing unsold inventory and rising carrying costs, have pulled back on new starts and are offering aggressive concessions just to keep sales moving. This uneven impact has created a patchwork market where pain is concentrated in certain segments while others hold up, at least for now. The broad averages mask deep local differences, and for both buyers and sellers, understanding these splits is now essential. The next wave of stress is likely to hit where unsold supply is highest and demand has thinned the most, especially in the sprawling subdivisions ringing both cities. On the ground in Austin, the impact of overbuilding has become impossible to ignore. In April 2025, new listings jumped 11.5% compared to the previous year, while actual home sales dropped by nearly 14%. The result is a widening gap between the number of homes hitting the market and the number being absorbed by buyers. For local builders, this dynamic has forced a dramatic about-face. Construction sites that buzzed with activity in 2022 and 2023 now stand partially completed, with framing crews idled or laid off mid-project. Internal memos from several mid-size builders, reviewed by industry analysts, describe a sharp pause in new starts and a scramble to offload finished inventory before carrying costs spiral out of control. One composite builder, active across the northern suburbs of Austin and parts of Williamson County, exemplifies the dilemma. In March, they reported their largest ever backlog of unsold homes, nearly 400 units, spanning everything from entry-level townhomes to four-bedroom family houses. By June, only a fraction had moved, despite a wave of incentives, rate buydowns, free appliance packages, and even offers to cover a year's worth of HOA fees. As sales slowed, the company halted new permits, mothballed several planned phases, and began negotiating with lenders to avoid breaching loan covenants tied to absorption rates. In internal communications, executives described the situation as a builder bottleneck, a mechanical logjam where more homes are delivered each month than buyers are willing or able to purchase. This overhang is not limited to a single firm or subdivision. Across the Austin metro, city permit records show a spike in completed but unoccupied homes, many of which never make it to the public MLS. These so-called shadow inventory units add another layer of complexity as builders quietly shop them to institutional investors or bulk buyers in hopes of clearing the books. Meanwhile, resale sellers, often unaware of the builder backlog, find themselves competing not just with each other, but with a steady stream of new, heavily discounted properties. In neighborhoods like Manor and Leander, it's not uncommon to see 3 or 4 nearly identical homes on the same block, each one advertising a fresh round of price cuts or closing incentives. The numbers tell the story. In the first half of 2025, Austin's new listings outpaced closed sales by a margin of nearly 2-to-1. The months of inventory, already at historic highs, continue to climb, with some analysts warning that absorption rates could stall further if buyer demand weakens. Builders, once the engine of the region's growth, now face hard choices, pause projects, discount aggressively, or risk being left with unsold homes as carrying costs mount. For construction workers and subcontractors, the slowdown means fewer jobs and uncertain prospects, as crews are reassigned, furloughed, or let go entirely. This builder bottleneck is a key reason why inventory levels remain stubbornly high, even as overall sales activity softens. It's a mechanical process, driven by the lag between when homes are started and when they're actually sold. In a market where every extra month of inventory puts downward pressure on prices, the consequences ripple outward, from developers to homeowners to entire neighborhoods struggling to regain their footing. Affordability in Austin and Dallas is now shaped less by headline prices and more by the relentless climb in monthly costs. For many would-be buyers, the math simply does not work. In Austin, the affordability index ticked up from 0.51 to 0.60 by June 2025. An improvement, but still well above the national median, and far from the days when homeownership felt attainable for the average local salary. The surface-level price correction, down from pandemic peaks, has not translated into relief for most households. Instead, the burden of ownership has shifted from sticker shock to a monthly squeeze. Mortgage rates hover between 6 and 7%, a reality that has become the new normal. For a median-priced home in Austin, monthly payments including principal, interest, property taxes, and insurance now routinely top $4,500. Property taxes alone, at 2.1%, add more than $11,000 a year to the bill. Insurance premiums, spurred higher by recent storms and inflation, average $5,000 annually. Even buyers with substantial down payments find themselves staring down costs that rival luxury rents. In Dallas-Fort Worth, the equation is only slightly less daunting. While median prices are lower, elevated taxes and insurance still push monthly carrying costs far above what many dual-income families can safely budget. A composite economist who tracks the region's housing trends describes the dynamic in blunt terms. We're seeing a market where the sticker price is only half the story. The real barrier is the monthly payment. For a lot of families, it's just not sustainable. This cost barrier explains why, even as inventory piles up and sellers cut prices, demand remains tepid. The pool of eligible buyers has shrunk. Not because people do not want to own, but because the financial hurdles are simply too high. Financing headwinds have changed the psychology of the market. During the boom, buyers rushed to lock in low rates and feared missing out. Now many sit on the sidelines waiting for rates to fall or for incentives to close the gap. Lenders report a surge in pre-approval applications that never convert to offers. Agents describe open houses filled with curious onlookers who ultimately walk away. Deterred by the monthly math, even buyers who qualify on paper hesitate, wary of committing to a payment that consumes such a large share of their income. The strain is not limited to new entrants. Homeowners who bought at the peak, often with minimal down payments and variable rate loans, now face budgets stretched to the breaking point. Some have become house poor, unable to move or refinance, while others are quietly listing homes in hopes of escaping a financial trap. In both metros, the share of distressed and pre-foreclosure listings is inching upward, especially in exurban neighborhoods where taxes and insurance hit hardest. Affordability, once a selling point for Texas cities, has become the market's central obstacle. The numbers are stark, but the impact is deeply personal. Families delaying moves, young professionals abandoning plans to buy, and sellers forced to accept less than they owe. For Austin and Dallas, the future of the housing market now hinges less on how many homes are for sale, and more on whether anyone can afford to buy them. Austin and Dallas now rank among the top buyers' markets in the country, but the mood on the ground is far from celebratory. Redfin's latest ranking puts Austin at #1 for buyer leverage, a title that once would have seemed impossible. The reality behind that ranking is visible in empty apartments, rising vacancy signs, and mounting legal filings. In Austin, the rental vacancy rate has climbed to 9.3% by mid-2025, up more than 50% from just 2 years earlier. Dallas-Fort Worth stands even higher at 9.7%, the most since 2012. These figures aren't just statistics. They reflect thousands of empty units across both cities, many of them in new luxury buildings that filled quickly during the boom, but now struggle to attract tenants. Landlords offer months of free rent, reduced deposits, and other concessions just to keep occupancy up, but the supply keeps outpacing demand. This glut of vacant rentals is colliding with another crisis, a sharp rise in eviction filings. In Travis County, which includes Austin, annual eviction cases are on track to hit nearly 20,000 in 2025, a jump of 58% since 2023. Dallas County courts report a similar surge with projected filings for the year exceeding 32,000, up almost 50% in the same period. The hardest-hit neighborhoods are those with the most new construction and the greatest share of working-class renters. Legal aid groups in both cities report record demand for eviction defense, as families struggle to keep up with rent hikes and landlords, facing their own cash flow problems, move quickly to enforce leases. For investors, the message is clear. The promise of easy returns in Texas real estate has faded. Rising vacancies mean weaker rental income, while eviction spikes signal deeper instability. Some institutional owners have already paused acquisitions or begun quietly selling off properties, wary of exposure to a market where both occupancy and rent growth are slipping. The feedback loop is unmistakable. As investor confidence wanes, more properties hit the market, adding to the supply and reinforcing the cycle of softening prices and rising risk. The optimism that once defined Austin and Dallas housing has given way to caution, with investors and landlords recalibrating their expectations in real time. Migration, once the engine of growth for Austin and Dallas, is now sputtering. The flood of new arrivals that fueled the housing boom has slowed to a trickle. State records show a sharp drop in out-of-state driver's license transfers, one of the clearest signals that fewer people are moving in. In Travis County, new license issuances to out-of-state residents fell by nearly 20% between 2023 and mid-2025. The trend is mirrored in Dallas County, where transfer volumes have slipped back toward pre-pandemic levels, erasing years of rapid population gains in just a matter of months. School districts across both metros are feeling the change. In Round Rock and Leander, two of Austin's fastest-growing suburban districts, new student enrollment growth has slowed dramatically. Some schools that scrambled to add portable classrooms during the boom are now facing flat or even declining headcounts. District finance officers report that projections from just 2 years ago, built on the expectation of relentless in-migration, now overstate actual enrollment by hundreds of students. The same pattern is playing out in Dallas suburbs, where districts in Collin and Denton counties have revised their forecasts downward for the first time in a decade. Job growth, too, has lost momentum. In Austin, the tech sector that once drew thousands of high-skilled workers is shedding jobs. Major employers, including Meta and Tesla, have announced rounds of layoffs or slowed hiring in 2024 and 2025. Local job postings in tech and related fields are down by double digits compared to the previous year. Recruiters describe a market where candidates are more likely to be looking for work than relocating for new opportunities. The impact is visible in apartment leasing offices, where traffic from relocating professionals has dropped off, and in the resale home market, where the pipeline of new buyers is thinner than at any time since 2015. These shifts are not just statistical. They erode the very foundation of housing demand. With fewer newcomers, every home that hits the market competes for a shrinking pool of buyers. The risk is clear. If migration continues to slow and job growth remains anemic, the pressure on prices and absorption rates will only intensify. For Austin and Dallas, the era of easy population-driven growth is over, and the housing market must now contend with the realities of a softer, less predictable demand base. Certain signals now demand close attention from anyone tracking the Austin and Dallas housing markets. Days on market, or DOM, has become a key barometer. In Austin, homes now average more than 70 days before selling, triple the speed seen during the pandemic boom. Dallas sits just behind, with listings lingering for around 60 days. When homes take this long to move, it's a sign that buyers are firmly in control, and sellers must adjust expectations. Months of inventory is another critical number. In both metros, supply has climbed above 6 months, a threshold that tips the balance toward buyers and puts steady downward pressure on prices. This metric reflects the time it would take to sell every home on the market at the current pace of sales. When inventory rises faster than demand can absorb, price reductions become routine. The ratio of price reductions per listing now serves as a warning light. In Austin, nearly 60% of active listings have seen at least one price cut. Dallas is not far behind. The timing of these reductions matters too. Most occur within the first month, but homes that haven't sold by day 45 are much more likely to be withdrawn or see further markdowns. Economists point to a set of scenario triggers worth watching. A sustained rise in mortgage rates above 7%, another wave of tech layoffs, or a further slowdown in migration could all accelerate downward trends. Conversely, a broad drop in rates or a surprise return of job growth might stabilize conditions. For now, the direction of these indicators will set the tone for the next year in Texas real estate. Vigilance, not wishful thinking, is the order of the day. In August 2025, over 80% of homes in Austin sold below their original asking price, a number that would have been unthinkable just 3 years earlier. This documentary has shown how both Austin and Dallas shifted from record-setting booms to a period of sharp correction, with inventory in Austin reaching the highest March levels ever recorded, and Dallas inventory up 53% in 1 year. Affordability has improved on paper, but monthly costs and mortgage rates above 6% still keep many buyers on the sidelines. While experts agree that the power has now shifted to buyers, the long-term effects of rising vacancies, increased evictions, and slowing migration remain unclear. What happens as supply continues to outpace demand, or if interest rates stay high, is still an open question. For now, the evidence points to a market correction, one deeper and more complex than headlines suggest, and one that is still unfolding.